Hello and welcome to my next Warren Markets episode. Well, today was a very topsy-turvy market today, where the Nifty and the mid-cap index ended up flat, and the micro-cap and the small-cap index were sharply down. The advanced decline was heavily in favor of declines, with only about 700 stocks advancing, but 2,200 stocks declining. The story of the day is also one of the markets falling sharply and then recovering during the day. So what actually happened today? Well, the first thing is that on the geopolitical front, actually oil was about $107, but the rupee continued to be under pressure and finally breached the 96 mark with the 96.35 today. The US dollar continued to be strong, the DXY almost at 100, US interest rates continue to be high, and the 1-year forward premium for the first time ever looked like 392 swap points took the forward rate to more than $100. So naturally, the pressure on the currency was there. But this was more from an understanding of the oil price and its impact on the fiscal and the current account deficit and all of that, because FIS actually bought today about 2,000 odd crores, and DI has also matched it to same around 2,000 crores. So how does that explain what happened in the market today? Well, then if you look at all that I said, it is clear that retail panic is continuing in terms of the selling of what we saw on Friday is continued today, but FIs stepped in probably, and DI has also participated in buying some of the counters which had corrected a lot. What they bought, both DIs and FIs, was also correlated to the currency weakening. So we saw pharma and healthcare doing well, we saw private banks doing well, and you saw that IT for the second consecutive day ended up positive, right? So clearly, finally, the currency is dominating and they are buying into those that they see as hedges. IT index, even after these last 2 days rally, is still down about 25-26% year to date. So maybe both FIs and DIs feel it has come into a value zone, right? But otherwise, all the rate sensitives, because with currency pressure and interest rates, and doesn't look like RBI is going to be anywhere near a rate cut, there's going to be pressure, and rate sensitives again were the worst performers in terms of auto, consumer durables, and the like. So as we now post market, as I'm recording this later in the night, oil has again crept back to $111. But every hour I see that there is some news flow around the war, some positive, some negative. Iran, America saying he'll arbitrate Iran if they don't agree. But Iran says they put together a proposal where they'll keep the enriched uranium with Russia but not with America, and then they agree to reopen the Hormuz Strait. So all kinds of complicated proposals are doing up and down, and I don't know how much of this is real news. A lot of it could be fake news also. So the uncertainty continues, and the oil market is the best reflection of that uncertainty. The fundamentals of the country, thanks to the oil and the currency, have definitely taken a hit, and the deteriorating financials, and with government only passing on 3 rupees in petrol, the rest of the burden is going to be taken between the OMCs and the government. And if it's the OMCs, it means a much lower dividend from the OMCs to the government. So clearly, there is no clarity yet on whether the government, how are they going to manage the fiscal deficit? Are they going to take a one-time gap and not meet with their own commitment in the budget? Or are they going to cut down on capex? Or are they going to raise taxes through some other source? So all of this uncertainty is playing on to the currency, and hence FIs, however, are being very tactically smart, because in the options and F&O data is still heavily on the short side. So some amount of today's buying could be treated as short covering, but some of it could be that they're actually buying the currency hedges like IT and pharma. So what about tomorrow? Well, like we said, it's the Trump tantrums. Earlier it was Trump tariff tantrums. Now it's the Trump tweets and tantrums on the war, which are keeping the whole market on the edge. And one has to just keep sticking at one's asset allocation and diversification and stick at it, because for all you know, suddenly the war could take a turn for the better and people say we have signed a deal. But until the deal is signed, you can't say when it will be signed. So strategy-wise, nothing needs to change. Stick at it. The retail, which went through a strong buying whole month of April and early part of May, is now seems to be booking profits or panicking, depending on the way you look at it. But as a long-term investor, your strategy has to be clear that you will stay diversified, and you will have a medium-term perspective, and you will put only small amounts into the market on a daily basis. Right? Thanks, and look forward to tomorrow's update.